Welcome to Bloomberg BusinessWeek. I'm Carol Massar.
And I'm Jason Kelly. We're here at Bloomberg headquarters in New York.
This week in the magazine, Contact High. Warby Parker bets its vision for selling glasses will work for daily wear lenses.
Plus, Visa CEO Al Kelly, no relation, says consumers are still swiping and tapping despite talk of a recession.
And then there's this week's cover story, Google and the generals. The search giant wants to build its military business. Its employees, though, they do not.
Much more of that ahead, but we begin with our top stories. A busy week in D.C. with impeachment hearings, trade talks hitting a series of road bumps, so much more, and legislation passed by Congress supporting Hong Kong protesters. Let's break it down with Ryan Teague Beckwith in D.C. So, Ryan, help us understand everything that happened there in the nation's capital.
Yeah, this was a long week, and I think the last slow news day was June 15th, 2015. This was a particularly newsy week. The Sondland testimony from the ambassador to the EU on what day was that even?
That's Wednesday, how long of a week it's been.
Wednesday. The Sondland testimony on Wednesday established pretty definitively that there was at least one quid pro quo holding out the White House meeting in exchange for investigations into the Bidens. Sondland testified that he was not definitively sure that there was a second quid pro quo on the aid, but that establishes a sort of pattern. And as the questioners, the Democratic questioners sort of made clear, a White House visit is an official act, which would be the statutory term for something that could be considered a thing of value in a bribery case. So they could have an article of impeachment itself just on holding out the promise of a White House visit in exchange for a personal favor of investigating the Bidens.
All right, Ryan, as you said, a very long week. So we had the impeachment hearings going on. We also had trade talks again. And I feel like I've said this so much over the last few years in terms of U.S.-China trade negotiations. 2 steps forward, 1 step back. Where are we?
I mean, it exists in a nebulous zone right now. Trump has been using Twitter to argue that Democrats should be somehow advancing a trade deal that he hasn't sent to them. I actually think that the impeachment means that both on the domestic side, that both Trump and Democrats will want to do it. For Democrats, it's a way of saying, look, we're not just out to get Trump. We'll work with him on something we can agree on. And this is one of the few things that they both agree on and have made some progress on. Like they agree on infrastructure, but they've made no progress on that.
Well, and
yes.
Speaking of agreement, Ryan, a rare bit of agreement on Capitol Hill supporting the protests in Hong Kong amid these trade talks. What do you make of that?
Yeah, the Hong Kong is what complicates it, obviously. I think if the situation there gets much worse, it could make it very hard to continue to have this level of agreement. No U.S. politician wants to be speaking out against Democratic protesters in any country, especially those who cite America as a role model, and especially in a place like Hong Kong that's also strategically important. So if China takes too hard of a stance there and things get really ugly, then that is probably the biggest risk to getting a deal.
I have to say, Ryan, from those of us here in New York, it really felt like a surprise when we saw Congress passing that legislation. It was like, wait a minute, where did this come from? What was the talk down in Washington about the support by both the House and the Senate in terms of those Hong Kong protesters?
Well, I mean, like I said, there are just certain things that you don't want to be on the wrong side of. And those are things that are going to, anything that where Americans broadly like that, anything where you think you could be hit by it. And I also think, just generally speaking, that a lot of politicians down here genuinely side with the Hong Kong protesters, think that they have a strong argument and that they're making a good case, and they want to support them, and they don't want the U.S. to look like it doesn't have their back.
All right, Ryan Teague Beckwith, we're going to leave it there. Thank you so much for wrapping up a very busy week in Washington. Well, from D.C. to London, a story in the magazine on how Brexit's chaos it's opening cracks in the UK's 300-year-plus union.
Yeah, this is also going on. This week, a televised debate and election campaigns also picking up momentum. Let's head to London, check in with Tim Ross. So much going on. Busy here in the States, busy over in the UK. Let's talk about the election trail. News from there. There was a lot of momentum. Tim, what's the momentum that we need to know about as investors?
Well, at the moment, the Conservative Party is still ahead comfortably in the opinion polls of Jeremy Corbyn's Labour Party. But in the first of the televised debates between Boris Johnson, the Prime Minister, and Tory leader, and Jeremy Corbyn, who is challenging him from a really quite a hard left-wing socialist angle, they ended in a bit of a draw. It was a kind of stalemate. Everyone was really expecting Johnson, or most people were expecting Johnson to do well. He's a famous campaigner. He won the Brexit campaign for those pro-Leave voters in 2016. He's won 2 terms as London mayor. And he was picked really by the Tories as someone who could defeat Corbyn. But in that first debate on Tuesday night, it was declared a draw really in the first opinion poll that was taken afterwards. That hasn't really moved the dial in terms of where the parties stand. But Corbyn isn't doing terribly, and Johnson isn't doing brilliantly at the moment.
And so as we look ahead, it feels like we're working under the assumption there's going to be some sort of Brexit. And as we think about the implications of that, there are real implications if you look especially north of where you are to Scotland. And that figures into a much larger and maybe in some ways more limited future for the United Kingdom. Tell us what you've learned.
Well, as in the magazine this week, we have a story in there about the future of the UK potentially being at stake in this election. If, for example, the Conservative Party doesn't get that majority, and if the Labour Party managed to squeeze into power with the support of potentially the Scottish nationalists who are saying they would help get Jeremy Corbyn into 10 Downing Street, that would give the pro-independence campaigners in Scotland a really big boost, the kind of boost they haven't really had since Scotland voted in its own referendum in 2014 on the question of whether to break away from the UK. Nicola Sturgeon is this sort of tough firebrand leader of the Scottish National Party, and she is very sure that Brexit means Scotland must now get a vote on its own future and whether to break away from the rest of the UK. And if she helps Jeremy Corbyn get into power, he might just give her that vote.
Well, and it's interesting because in this story, we actually talk about Boris Johnson, who has talked about, after we get through Brexit, that the United Kingdom will be more united than ever. But really what's going on, I mean, it's a bigger question out there that will ultimately everyone come together, or do we see kind of an undoing of the United Kingdom as we've known it for such a long time?
Well, it's when you have these seismic shifts in political debate and in political allegiance and people's identities change, as you see quite often in referendums, and we've seen that in Scotland and we've seen that in the Brexit aftermath across the whole of the UK, that in the end politics can change and countries can decide their own destiny in different ways. Another case we looked at was the situation in Northern Ireland, where for the first time really people are starting to talk a bit more about the question of whether the North should join up with the Republic of Ireland again. It's not in any way on the cards immediately, but you can see a reality in which Scotland goes first and then maybe the calls grow for a unification referendum in Ireland too.
Amazing.
Changing world,
Seismic shifts, it feels like, happening over in your part of the world. Tim Ross, thank you so much joining us from London. Well, coming up here in the U.S., joy replacing gloom when it comes to the economy. It's done a 180.
Completely. Plus, Visa CEO Al Kelly, no relation, while he says consumers are still spending, swiping, and tapping.
This is Bloomberg BusinessWeek.
Welcome back to Bloomberg BusinessWeek. I'm Carol Massar.
And I'm Jason Kelly. Join us for Bloomberg BusinessWeek every day on the radio. That starts at 2 p.m. Wall Street time. You can also catch up on our daily show via podcast. Get that at Bloomberg.com or wherever you get your podcasts.
And of course, you can find us online at businessweek.com and on our mobile app. In the economics section, a global sigh of relief. I'm just going to say, what a difference 3 months make. Sentiment has improved, and we're also hearing less about the risk of a recession.
Here's this week's Business Week Explainer.
On August 14th, all the indicators were bad ones. Major U.S. stock indexes fell 3%. The bond market was signaling a recession was in the making. and the trade war between the U.S. and China wouldn't go away. Hope you didn't panic and sell everything back then, because the attitude has since gone from doom to boom. American stock indexes are setting records almost daily. Sentiment has changed, too. According to a Bank of America Merrill Lynch survey in August, global fund managers, they overwhelmingly expected slower growth in the coming year. Now, in November, most of those surveyed expect stronger growth in the coming year. What's the biggest reason? A change in central bank policy. Almost a year ago, the Fed was planning on 3 quarter-point interest rate increases in 2019. Instead, it cut rates 3 times this year, 2 of them coming this fall. Meanwhile, the European Central Bank has become more dovish too. Still, economists aren't completely sold. They see business investment lagging. They wonder whether the recent strength in the economy is sustainable or the last gasp of an expansion that's past its prime.
And if indeed the expansion is past its prime.
We sat down with the economics editor behind the story. You just heard the sultry sounds of his voice, Peter Coy. He joined us in studio.
That's the fly in the ointment. The consumer is really strong in the U.S. U.S. consumer, we had to pick one force in the entire global economy. It's the U.S. consumer out there still spending, but support in a sustainable way, because real wages, that is adjusted for inflation, have been rising, and unemployment is super low. So people have spending power. They're not carrying a lot of debt. The question is, can this keep going for a long time if businesses are cutting back? Because businesses cut back on spending, maybe they're going to cut back on hiring, maybe some of that, the income of the consumer will eventually trail off. Now, Ed Yardeni Research, one of the really smart guys on Wall Street,
Love Ed.
was telling me that he thinks that the downturn in capital spending is misleading, because a lot of it has to do with the oil patch, which we know is weak.
It's important.
So if you take that out, things kind of look better. And tech, healthcare are doing relatively better.
Too.
Finance, yeah.
Which are key areas.
Yeah. So, but it remains to be seen. That's still an open question.
Because I do feel like we did hear some caution on earnings calls from CEOs, essentially saying, you know what, I'm pulling back a little bit, or I'm not spending on that new factory, or I'm not expanding maybe as aggressively as I could.
Right. And historically, capital spending is much more volatile than consumer spending. Consumer spending is it tends to kind of just rise gradually. Capital spending is all over the place. So that's what you want to pay attention to. Even though it's not as big as consumer spending, it can kind of be the thing that wags the tail that wags the dog.
And I think the magazine has covered that the longer you get into an expansion, like here we are, the longest U.S. economic expansion on record, the longer that you're in it, that to keep it going, that's where capital expenditures usually typically come in towards the end and give it that last kind of oomph. And I wonder if that's the case here.
Well, this has been such a long cycle. It's in its 11th year now. The capital spending has had its own mini cycles within that. We've had our ups and downs. And if we get another up here, it could really be good news for keeping this thing going.
And staying with economic growth and consumer spending,
We sat down with Visa CEO Al Kelly for another edition of BusinessWeek Talks.
Despite all of this thought that there's a recession coming, we don't see it. In fact, our fourth quarter numbers, which for us were September 30 numbers, were better than the third quarter. The U.S. was up 8%. The international was up 12%, excluding China. Europe was up 13% when you exclude the UK, which has done a little bit of self-inflicted wound to themselves.
So what's wrong with everyone that we're talking so much about recession?
I think it must just be the cycle. It's been a long time that we've had this upswing, and I think that people just look at the history and say it's got to go down at some point. But, the consumer has stayed extremely strong around the world. The only place we see any weaknesses in the UK. And as I said, that's kind of related to the whole Brexit situation. But other than that, the world looks pretty darn good.
what are they buying? Where's their money going?
In our world, there's a couple of things that are really driving the increases in the number of transactions we're seeing. One is obviously e-commerce. People are jumping on their phones and jumping on their iPads and jumping on their computers and buying in big ways. We're seeing every month those numbers, the growth in e-com is anywhere between 2 and 3 times the growth in the face-to-face world every single month. We're also seeing people continuing to travel. There was a real downturn in travel back in December and January. If you remember, that's during the height of the U.S.-China trade talks. It was during the height of the Brexit conversations. And then we had the 45-day U.S. government shutdown. And almost immediately, consumers started to just stay at home and not travel. But we've seen that pick up, especially in the last 6 months. And that's always a good sign that when people are willing to leave their home country and go to another country, that's a very, very good thing. The other thing that we're seeing is an increased amount of smaller ticket items being used using digital payments. And a lot of that, I think, is driven by mass transit.
I agree.
We are really excited about mass transit. Just in the last 90 days, we've seen open systems in Edinburgh and Sao Paulo. We started in June here in the MTA in New York, where we're only at 18 stations from Grand Central Station to Atlantic Avenue in Brooklyn. But by the end of October of 2020, the MTA hopes to be in all 424 subway stops.
Are people using it? It's
Absolutely.
the whole idea of tap and go, right?
Absolutely. It's tap and go. It's so convenient. It's better experience for the merchant. It's better experience for the consumer. We hit 1 million transactions in the first 7 weeks, and we had and that's at 18 stations. It's truly amazing. Absolutely continuing to grow. Tap to pay has grown hugely around the world, with the exception of the United States, interestingly enough.
Coming up, pun alert, retail is in focus.
Warby Parker eyes another revenue stream.
This is Bloomberg BusinessWeek. Welcome back to Bloomberg BusinessWeek. I'm Jason Kelly.
And I'm Carol Massar. You can also listen to Bloomberg BusinessWeek on the radio on SiriusXM Channel 119 and on AM 1130 in New York, 106.1 in Boston, 99.1 FM in Washington, D.C.
AM 960 in the Bay Area, in London on DAB Digital and through the Bloomberg Business app. Well, over in the features section, Warby Parker focusing on contacts.
See what you did there. Well, the brand made a name for itself, of course, with affordable direct-to-consumer glasses, and just like its signature frames, well, the focus will be on keeping the price point low. Warby Parker's co-founder and co-CEO spoke with Bloomberg about the rollout.
We're super excited to be able to introduce a daily contact lens at a much better price point than you can find elsewhere in the market, and it's really the first opportunity for contact lens wearers that have been wearing extended wear, so 2-week or monthly lenses, really their first opportunity to enter into an affordable daily contact lens.
And here's BusinessWeek's Austin Carr on what it means for Warby Parker to become the Warby Parker of contacts.
Just a few years ago, we were talking about the retail apocalypse, and in many ways, we're still talking about this is the one company that sort of bucked that trend. They back in 2010, Neil Blumenthal and Dave Gilboa came up with this idea to disrupt Luxottica, which was this massive conglomerate in the eyewear space that was sort of a monopoly. A lot of analysts think when it comes to distribution,
they
licensing,
own all the eyeglass manufacturers.
Ray-Ban, Sunglass Hut, Pearl Vision, what have you. And they often marked up their frames massive rates. I mean, just if you buy Ray-Bans for a couple $100s, they're pretty expensive. With Warby Parker, they had one low price point of $95. It was just very straight for direct-to-consumer marketing, so they sold online, then eventually moved on offline into physical retail. And they've really become known as this sort of bespoke brand that has this end-to-end customer experience that's very seamless. And you've seen a lot of copycats in that trend.
Well, and it is this sort of threading of the needle, as it were, getting toward where it feels like we are, especially high-end consumers who expect high-touch retail, but also the convenience that you get from online. I mean, the process of Warby Parker, it's pretty great.
It's pretty good. I mean, what they became known for was this at-home try-on experience. If you've ever gone to a store and you look in front of that little mirror, it's self-conscious, you feel a little awkward doing that. They send you 5 pairs in the mail, you get to try them on for free, then send them back, and they send the one that you pick once you pay for it. It's a very seamless experience. And if you've been to the stores, especially around in New York, they're beautiful, they're gorgeous, they're very seamless, and it doesn't feel like a stodgy optometry office if you've ever had that experience of being upsold by your doctor.
And you really went right there to one of the tensions of this story, which is, okay, selling a razor online, not that complicated. Selling socks online, not that complicated. But when it comes to your eyes, it is a little more complicated. There's a whole sort of established way that people do this.
Well, if you screw up, you can really screw up somebody's eyes.
Really, there can be infections, there can be eye disease. And so that's a big thing. It's a much harder category to get into, but they think it's an $11 billion market.
The contacts category.
Contacts category and eye exams. That's one of the big things that they have to push into. Because although they've done prescription eyeglasses for a while, for many years, putting something on a piece of plastic, a piece of silicone on the end of your eye, obviously is a little bit more dangerous, especially when you're ordering these things online. They're also part of a big category that Luxottica also owns, which is, they have people that prescribe the contacts. They own iMed, which is the second largest vision insurer in the company. And they've really locked Warby Parker out of that market. You can't buy your glasses in network through vision insurance. And so they basically said, we're going to do this on our own. Instead of just glasses, we're also going to offer contacts and do the eye exams. They're tripling the number of optometrists they have on staff who are going to basically help you with your insurance and then hopefully, sell you contacts and Warby Parker glasses downstairs.
One of the things you get into, though, Austin, so here they are like looking to go from glasses now to contacts, kind of build out the vertical if you want. But what's interesting is I think the question is, are they expanding too late? Like, are they, here they created this model, and now that they're spreading out, did they just wait too long to do this?
I think that's a fantastic question, especially we note in the story, one of their co-founders, Jeff Rader, actually left in the early days to launch another unicorn, which is Harry's, the Warby Parker of shaving, which has a $1.4 billion valuation, I think. And then a couple of their other executives went on to found Away, which is the Warby Parker of luggage, which again has a $1.4 billion valuation. So it's a really good question whether or not they waited too long. At the same time, they really pitched this idea that they don't want to chase the flash in the pan, different verticals. A lot of the VCs that they were talking with in the early days said, become the next Shoe Dazzle, become the next Groupon. And they said, we're just going to be focused on this one thing. We do it really well. And now we're going to expand a little bit more. And they pitch this as sort of the anti-WeWork. They don't want to be this crazy, massive $100 billion overnight SoftBank investment. They want to be the mature, step-by-step, incremental growth company.
Well, and I feel like that speaks to who these two guys are. You get into it a little bit of kind of how they manage this company, their approach.
They're very, if you spend time with Neil and Dave, they're very precise. They're as precise as the prescriptions in their glasses. They really have this attention to detail. They're not, the Adam Newman type characters that are just going to sort of brag about, tomorrow we're going to triple the size of this. One of the guys said, we're comfortable launching 33 stores this year, 40 next year, 45 the year after that. This is not, we're going to launch 500 stores tomorrow.
Well, and it's also interesting to think about this business, especially this expansion into contacts and eye exams. And you alluded to this earlier, Austin. This is a people-intensive business. There's, in addition to the manufacturing they're doing, these are big jobs, a lot of jobs in a lot of ways, and high touch.
It's not, what they've also been pitching is it's not just the in-store experience, but all the under the hood refinements. They have an optical lab where they do a lot of their manufacturing in upstate New York that has about 100 jobs. And they're also pushing into telemedicine, which is a massive category that we've seen other eyewear makers move into. And that's basically the process of, can you update your prescription using just your phone and a MacBook? Essentially, you can measure the distance between your laptop and your phone, and you can check your eyesight doing an eye exam at home. Seems risky,
I know,
but that could be the future.
Right.
And if they're pitching it as not a replacement but a complement to eye exams. Some people think it's risky. A lot of optometry community really felt this is a bad move by the industry, but it seems to be where it's headed.
Coming up, Google wants to do business with the military.
It does indeed. Some of its employees, however, do not. It is this week's cover story. It's coming up next.
This is Bloomberg BusinessWeek. Welcome back to Bloomberg BusinessWeek. I'm Jason Kelly.
And I'm Carol Massar. Still ahead, a special pursuits event. We're talking about the year ahead in luxury. We'll hear from Tiffany's CEO on how legacy luxury greets the future and also its possible sale to Louis Vuitton. We had some fun stuff to talk about, but then we had to get down to some serious stuff because there's a deal in play.
That's exactly right. And on a very serious note, we have an in-depth look into a sexual abuse case before the UK Supreme Court. It could establish that Barclays is responsible for harm caused decades ago. It also looks at a precedent that could be set around the gig economy and the culpability of Wall Street.
All right, first up, though, we do want to get to this week's cover story. Over the past 2 years, Google has been pushing to win military contracts, a potentially huge line of new business that could help the company finally diversify beyond search.
But there is a problem. Some of Google's employees, they hate this idea. Here's reporter Joshua Brustein with his story.
We tell the story of Google's basically tortured relationship with the Pentagon. We really saw this come out into the public view early last year when Google employees began objecting to what had been a secret military program called Project Maven to use advanced artificial intelligence technology to analyze drone imagery. And so this was a program that drones gather an immense amount of video. Actually, analysts watch it for the most part. And the Pentagon said if we could have some sort of automated analysis that would just tell them which parts to watch, that would be useful. Google was one of the companies who was helping with this. Some of its employees said that seems like we're getting too close to building weapons, and basically broke out into this huge public spat.
And Google backed out, right?
And eventually Google decided not to renew its work on the contract, and stopped working on it earlier this year.
Well, it's interesting, and I think it speaks to the kind of tortured relationship that Google has with the government. Like we were talking in the newsroom about how for such a long time Silicon Valley big tech were kind of proud to kind of,
Tell Washington to kiss off.
Basically, thank you very much. And now they're embracing Washington, right? Because they are looking for new business lines, particularly AI or the cloud. They want to be more involved.
Yeah, I think what's interesting here is you have this very sort of visceral reaction to a specific military program. I think defense work makes a lot of people uncomfortable. But if you look a little bit below that, you also see another transition happening at Google that is making people at the company uncomfortable, which is it's trying to supplement its consumer business, the search engines, the email, all based on advertising, with a cloud computing business. Right. And that means basically entering into specific relationships with large institutions and helping them analyze their data and do something with it.
And so talk to us about Google specifically. We do go back to this, kind of ragtag startup back in Silicon Valley. I mean, it was in many ways the quintessential, university dropout, create this company that changes the world type situation. But as it's grown up, it's really had to wrestle with its own image and its own values in a lot of ways. And a lot of those came to the fore in the Project Maven protest. But this hasn't really died down that much in many ways. These discussions are still pretty fierce within the company.
Absolutely. I think in comparison to other large tech companies, Google has always kind of been the most extreme case of this Silicon Valley idealism. I think, that a lot of the work the company does is actually just kind of academic research. Its original mission was to organize the world's information. Initially even was concerned about maybe even going into advertising. It really just wanted to do the tech. Eventually it kind of got over that. And obviously the advertising is, the business right now. But you do see it's moving into new businesses and challenging its own assumptions at a time that sort of the Silicon Valley's culture generally is being challenged in many ways.
Staying with technology for a moment, Amazon is spending more than ever on lobbying in Washington, also locally.
But there are some things money apparently can't buy. Here's reporter Eric Newcomer with Amazon's political wipeout.
They spend a ton of money on lobbying, $4 million. In a quarter, I think they lobbied on more issues than any tech company last year. They spent about $1.5 million just on their local Seattle race. So Amazon is flooding politics with money. But then, as I document in the story, has a lot of problems, like issue to issue, just really struggling sort of with this techlash and to to win the political battles with all that money.
So is it the company at large has problems, or are there a few individuals who really have some problems?
Well, the company as a business obviously is doing great. But then, Jay Carney runs, former Obama press secretary, runs this huge policy shop with his deputy, this guy, Brian Huseman, former Republican administration, Federal Trade Commission lawyer. And together they've really tried to staff up so they're ready to fight. And so on a lot of issues, whether it's like trade wars, they have somebody in talking to the administration trying to lobby. But then on some of these bigger, more iconic issues, we talk about the move to New York, we could talk about Seattle, we could talk about this huge Jedi contract where Amazon was competing to win a $10 billion government contract, and then Microsoft came out of nowhere and took it from them. So Amazon has had just a lot of trouble on the policy front.
Well, and it's interesting too, because you document very well a number of these
Specifics.
cases, which you just described in brief. But what strikes me too is that on paper, it looks like they did all the right things.
Right.
They hire a big time Democrat, they hire a big time Republican. They've got the team in place. And then, and this feels very 2019, it's a bunch of unforced errors in a lot of ways that ultimately sort of set them back. Tell us about that.
Right. So if we take, Jay Carney, this very polished communicator, I think he's hired during the Obama administration when it seems like Hillary Clinton might win again. Amazon takes, responding to Trump tweets, a sort of almost hostile posture towards Trump. Then Trump's elected.
This is during the campaign.
Exactly, during the campaign. And then Trump's elected, and so Bezos and Trump have this very negative relationship, partially because Bezos owns the Washington Post. Then they have a Democrat as their chief sort of spokesman. So that's a challenge. And then time passes, and Carney has now more recently given an interview where he suggested that there weren't any patriots working in the Trump administration, unlike the Obama and Bush administrations, which he apologized for. He made this really bad tweet about umpires during the national games, so he's just had some challenges as sort of the public voice of Amazon. And then the other character is this guy, Brian Huseman, who's sort of the inside operator. And he staffed up this team, but there's just been a lot of drama internally.
Widen the aperture for us a little bit, because you look across the tech landscape, you understand how these companies work, not just Amazon, but the whole array, I guess, of social media companies, tech companies, who all of a sudden really have to care more about Washington, in part because Washington is all of a sudden caring a lot about them, and maybe not in a good way.
Yeah, I'm growing tired of the phrase, but we're in a techlash, right? That's what, and there's, an antitrust investigations, the Federal Trade Commission, the Department of Justice, the House Judiciary Committee, state attorneys general, everybody is investigating big tech companies, including Amazon, into antitrust. So
Democrats and Republicans are all in on this.
They're the punching bag. And so that's the situation Amazon faces. In my story, I talk about a lobbyist who, has a generally positive view of Amazon, sort of defending them, saying, some of the problems are just they've, grown so much. I think they doubled sort of the lobbying staff over the last 3 years. So that's part of the reason. But he says Amazon might have trouble, but they're doing better than Google and Facebook. And I think that is a sort of fair defense. I don't dig in to Google and Facebook. That's a whole nother dive. But there is a general sense that the tech companies in general are struggling to respond.
And coming up, a case before the UK Supreme Court could establish whether Barclays is responsible for sexual assaults alleged to have taken place decades ago.
And possibly set a precedent for today's gig economy. This is Bloomberg BusinessWeek.
Welcome back to Bloomberg BusinessWeek. I'm Jason Kelly.
And I'm Carol Massar. Join Bloomberg BusinessWeek every day on the radio starting at 2 p.m. Wall Street time. You can also catch up on our daily show by listening to our podcast at Apple Podcasts, SoundCloud, and at Bloomberg.com.
And you can find us online at businessweek.com and on our mobile app.
The UK Supreme Court will hold a hearing next week on a lawsuit against Barclays that has drawn the bank into a reckoning over sexual abuse and who should pay for it. It's a disturbing case and could have much broader implications.
It's a terrific and disturbing piece of journalism in this week's International Features section. Here's Max Abelson on how the story came about.
It was a long time ago. A couple of months have gone by since I was sitting in my Bloomberg Terminal, and I saw a story by Kay Wiggins, who was a great legal correspondent here. She's since left Bloomberg News. She writes in England about the law, and she wrote maybe a 4-paragraph story that said that a group of claimants, which are what plaintiffs in England are called, said that when they were teenagers and they were applying for jobs at Barclays, sort of low-level branch jobs in Newcastle, which is a northeast city in England, in that area, they said that Barclays said, okay, you have the job, but you have to go see a doctor, and you have to go see this doctor. His name is Gordon Bates, and you have to go to his house. And these people said that Dr. Bates sexually assaulted them, about 120 of them. And they wanted to hold Barclays responsible because Barclays had sent them to him. And they won. And then Barclays appealed, and they won again. And Barclays appealed again to the Supreme Court. And this news item said, the Supreme Court is going to be hearing this really interesting case. So I called Kay up and I asked her, do you think that this might make for an interesting feature story? And she said, I think it would. And we started working on it. And one of the first things we did is we got in touch with the court system in England and asked them for court documents, because it's such a fascinating story, but it hasn't gotten a lot of coverage.
No, it hasn't.
As sometimes court cases don't in England, where the coverage of sort of current legal questions are often quieter than in America. We got permission from the court, and in fact, we got through the court really, really fascinating documents that shined a light on how this happened.
Fascinating and disturbing.
Fascinating and disturbing. I mean, this was an upsetting story to work on. There's no doubt about it, and I'm sure it's an upsetting story to read, and it might even be upsetting for viewers and listeners to watch now and listen now. But what was really special is that we got a couple of people who had worked for Barclays and were sent to Dr. Bates to talk to us and to share their stories. And what our piece in BusinessWeek is, which I ended up writing with Gavin, with help from Kay, although as I mentioned, she left and I miss her.
Gavin Finch, a
deeply talented reporter in England for us here at Bloomberg News and BusinessWeek. What the story is about, on the one hand, it's about these visits to Bates and what ended up happening to our 2 main characters, who we call James and Anne.
Not their real names, right?
Aren't their real names. The court ordered us not to use their real names. It's partially about that, which is upsetting, but it's also, I think, a complicated and rich story about this really fascinating question of when a company has a responsibility to their workers. And in this case, Barclays says, Dr. Bates wasn't our employee. He was just essentially a contractor. So we're sorry if anything bad happened, but not our fault.
But Barclays sent possible employees to him, or once they were employees, to him for many, many years. Like, this went on for a long time.
Carol, went on for a long time. So it started in the late 60s and It ended in the mid 80s. And a few years later, Barclays says they stopped sending people to the doctor. Why they would send them to the doctor in the first place is a question you might have. They say it was make sure they were fit to work and have fit for, insurance. Barclays says that we only found out about this in around 2013 when people started complaining.
Right.
But without giving away too much, because I hope folks read the story, we have a court document that includes allegations that more than a half a dozen people and their parents called Barclays, called managers, called human relations people to say something really bad happened here.
Right.
And it happened start as early as the late 70s and into the 80s, but Barclays kept using Bates.
Let's get into this whole idea of, whether or not the firm takes responsibility for folks who were their employees, meaning the people who worked for them, right? And what happened to them by someone who was not technically a Barclays employee. And it gets to the heart of responsibility.
That's absolutely right. I mean, in a way, what we do here by chronicling capitalism is we follow the ways things change and the ways the relationship between companies and their customers, but also companies and their employees changes.
Right.
And, when Bates was alive, he would not have recognized this whole new kind of economy. You know, you have Uber, you have Deliveroo in England. It's this gig economy where these giants, these multi-billion-dollar companies, have saved a lot of money. They've saved both the cost of having to pay people on the one hand, and they saved legal liability on the other by saying, these people are not our employees. They're freelancers. We're a platform for freelancers. We're not employers. And in this case, the fight is similar. The fight is to hold Barclays responsible, or the legal word here is vicariously liable. And vicarious liability is sort of a boring sounding phrase, but it's so interesting.
Yeah.
Because it's a way of saying that you are vicariously liable for something he did. You know, Barclays in a way is in some sense an innocent party here, as a judge might describe them, because Barclays as an institution wasn't in that room. But the question is, are they responsible for what happened in that house in Newcastle, and what precedent might that set for the economy that we now live in?
Coming up, we will lighten it up a bit. We'll talk pursuits, looking ahead at the year in luxury.
We'll hear from the Tiffany CEO on challenges, consumer desires, and consolidation.
This is Bloomberg BusinessWeek. Welcome back to Bloomberg BusinessWeek. I'm Jason Kelly.
And I'm Carol Massar. You can also listen to us on the radio on SiriusXM Channel 119 and on AM 1130 in New York, 106.1 in Boston, 99.1 FM in Washington, D.C.
AM 960 in the Bay Area, and London on DAB Digital and through the Bloomberg Business app. We hosted a very special Pursuits event this week at Bloomberg headquarters. It was the year ahead in luxury.
And we've got the editor and the host of the event, Chris Rouser.
We started doing the Year Ahead in Luxury last year, which is a spin-off of our Year Ahead franchise. And it's a half-a-day conference, and we just get leaders from all different aspects of stuff we cover. So from food and wine to travel to fashion to cars. So we had Alessandro Bolliolo, the CEO of Tiffany, come in. We had Klaus Zellmer from Porsche come and talk about electrification. And then Steven Starr, the restaurateur, came, which is very cool, talking about what we can expect in food next year. So it was a really fun day, and we're very psyched to be able to do this every year.
Well, and one of the clear trends, one of the through lines seemed to be sort of more thoughtful approaches to all of this, sustainability and whatnot.
Yeah, so we, something that everybody in the luxury industry is talking about is sustainability, because it's on the minds of consumers, and fashion is a huge polluter, probably the number 3 industry in the world. And so, knowing that shoppers are thinking about that when they're buying travel, when they're shopping for clothes, we talked about it with these people, and not only sustainability from an ecological standpoint, but how do you grow a sustainable brand? How do you have equity in hiring practices? How do you build community around your supply chain? Like, how can you be good in a 360-degree way?
And at the Year Ahead in Luxury event, the lovely and talented Carol Massar spoke with the CEO of Tiffany.
I did. Talk about a timely interview. We talked about how legacy luxury greets the future, but of course we had to begin with whether or not they might be doing a deal.
There are many luxury brands, but when you take really top luxury brands, the big, let me say, mega brands, we talk about a handful of brands. And among those, you have actually some of them extremely successful that are part of big groups. Consider Vuitton, consider Cartier. But you have other brands that are super brands, super powerful, that are not part of big groups. Consider Chanel, consider Hermes. So honestly, seriously, I don't think that for this kind of level of brands, there is a magic formula. It's proven, can be one way, can be the other. What is crucial is that when you lead a brand like ours that has 182 years of history, you, at the end of the day, have to concentrate on the legacy that you receive and the beautiful product and promises that you made to your customers. This is really the key of success.
Indulge me for a second.
Please.
A Bloomberg opinion piece today, and it said, one of our writers said, a deal would benefit both sides. For the owner of Louis Vuitton, it would mean dominating the jewelry market. I mean, it would automatically give them a huge presence, while Tiffany could avoid the tricky task of executing a turnaround in a U.S. recession on its own. So I do wonder about being able to step away. We're part of the problem. We focus quarter to quarter to quarter. So when you're doing renovations on stores, when you're thinking about the future, you know, you get a report card every 3 months. And I think sometimes it makes it difficult for a publicly held company. Would there be some benefits from stepping away from that public spotlight?
Well, for sure, for any public company to be
Not necessarily Tiffany.
to be reporting every quarter, there is, of course, it's a check that you have to go through every quarter, and we take it very, very seriously because it's our shareholders and it's our obligation to not only report but also deliver results to the benefit of our shareholders. Having said so, I think as a leader of a brand with such an history, which means value, to maximize that value, I have and my team, we have to look at the quarter, but we have to look even more at the next 3 years, at the next 5 years. So this is, if you want, the real challenge in managing a brand with a legacy like Tiffany, because you have, of course, to maximize the profit for your shareholders, but this doesn't mean that it is just the sum of 10 good quarters. You have to think about the next 10 years.
Having said that, because I listen to what you're saying, is there a benefit to stepping away and being part of a larger company where you are part of a portfolio and you can do the things that you want to make sure that brand is around for another 100 years?
Well, honestly, I don't think we have ever diverted from doing the right thing, nor other brands that are listed. I think I give you another example. Look at Hermes. They're listed. They report quarterly results. I don't think they did the wrong thing. I think also Tiffany, we've been listed now for 35 years. Of course, there are moments where you are more successful, other moments less.
Right.
But I don't think we did made wrong decisions because we are listed.
Bloomberg BusinessWeek is available on newsstands now.
It is indeed, also online at businessweek.com and on our mobile app.
So what's your must read?
Max Abelson's story about Barclays. Barclays has been in the news a lot over the last couple of years. This is a story, though, that I feel like has gone under the radar. Some great reporting by Max and our team over in London. You're going to be surprised by this story, and it speaks to a larger issue about Wall Street accountability.
Absolutely.
Your must read.
You know, I have to say, and they're obviously very different stories, but the Google story, the cover story, is about Google, but it's also about what a company wants to be and its employees versus its management, its goals, its hopes, its dreams, and what it is at its core. So I found it to be a much more serious story in many ways than I originally anticipated.
And it's about Google getting into middle age, right? And as you said, what does it want to be in kind of its next big chapter? So a fascinating read. Do check out our Daily Business Week podcast as well. That's available at Apple Podcasts, SoundCloud, and at Bloomberg.com.
More Bloomberg Television starts right now.